Now that we have a solid understanding of what a supply and demand zone is and how to map it, the next logical step is to jump to the charts, run through some examples of simply just mapping out the supply and demand zones. Because one of the most important aspects of trading this approach is being able to effectively map and understand supply and demand zones, we're going to focus on actually drawing them and locating them on a price chart. Now, one thing I want to stress before we get into this particular video segment is I'm going to be focusing solely on mapping out supply and demand zones. I don't care necessarily at this point in time what happens to the right of the chart, if the zone is respected or if it's not respected or anything like that. Simply put, I am focusing on range created supply and demand zones and pivot supply and demand zones so that we can conceptually see how we map them on a chart. What we'll be doing in future videos as we navigate our way throughout the course content is we'll be building on this knowledge. We'll be able to identify zones that have a higher probability of working out. We'll also be able to look at how price returns to these zones, the inner workings between supply and demand, and how they relate to the overall order flow, and also how higher timeframes and lower timeframes work together so that we can build high probability trade ideas. But the first and most important part of understanding this strategy is simply being able to map supply and demand zones effectively. So what we'll do is we'll jump on a chart. Here we have US dollar yen, and I'm using a 15-minute chart just so that we can get a little bit more price action to build supply and demand zones. Again, I'm not really concerned about the result of the zone in question, but instead I'm going to be just mapping them out. So stay with me as we go through these because some of them conceptually won't do anything, but we're going to build onto that as we continue. So we'll start initially on the left side of the chart here. And as we can see, price is caught in a fairly large range, sideways price action. And as we can see, price is caught between a high and a low, and price really isn't moving outside of this large range. And then we finally see an expansion to the upside. Now, of course, like I said in the previous video, if the particular range is over anywhere from 6 to 8 candles, chances are that range is too large and is either going to be seen on a larger time frame or simply as a zone that maybe you shouldn't be focusing your attention on. And in this case, both are true. This would be a larger range or a range on a larger time frame, as well as something that we can navigate our way just to the right, and we can refine it to a more important piece of the overall chart. And what we can see is we do have a sideways correction in price. We have price that's trapped more or less within this range of price, and then we get an expansion to the upside. Basically what we've been able to do is take this entire range and simplify it to something a little bit smaller, something that's a little bit more conceptualized into a smaller amount of candles. Although, again, if I just move my bar, we have about 18 bars. We're really only concerned about 6 to 8. And what we can do is we can just begin to look at the 6 to 8. And what we can see based on the expansion to the upside is we actually have a sharp move to the downside followed by that expansion. So while we do have a range, we also have that pivot in the market. So what we'd be able to do from a supply and demand zone perspective is draw out a pivot demand using this sharp move to the downside to draw our zone. If we wanted to look to refine that to just one candle where the momentum of that move really arrived at, we could actually move it to this bearish candle before this large expansion to the upside that broke this range. And we'd be able to mark that as our demand zone. I'm going to leave it as the entire pivot, as this is the move, this sharp move to the downside that created that expansion to the upside. And then we'll just keep moving forward from a price action perspective. So as we can see, price rapidly expands to the upside, and then we get a sideways bit of price action, or more specifically, we get a sharp move to the upside followed by an expansion, or in this case, we have a sharp move to the downside followed by a true expansion that actually breaks out of the larger range. So from that, we can build another demand zone, something just like this. And now we have a demand zone, and we can just keep moving on to this top section, and where we can see quite clearly that we have a sideways range in price, and then we have an expansion to the downside. So what we can view this as is a supply zone, and we can draw it with the lowest low of the range to the highest high. I wouldn't necessarily be including this wick in my supply zone for a couple of reasons. One, because it does extend the supply zone quite rapidly, and we're more interested in what's happened just before that move that expanded to the downside. But that being said, if we just do a really quick measurement of how much this zone really gets added onto, it's about roughly 2.5 pips. Is 2.5 pips really going to make or break your supply or demand zone? Not necessarily. So it's not a huge issue. And now if we just look at that, so we have this range in price, the expansion out of that range, we know it's a supply zone. What we can also see is that we actually get a sharp move to the upside followed by that expansion to the downside. So we can actually refine this particular supply zone to this candle, and now we have a pivot supply that we can be looking at. And then we can see that price expands to the downside and continues on. And then what we can see is as price interacts with this demand zone, we do get a reaction. The reaction is not successful and price does continue to break to the downside. And in future episodes, we'll explain why the likelihood of this demand zone holding was not overly high. But again, for now, we're going to primarily focus on just drawing out supply and demand zones so that we can just understand the inner workings behind the charts. So when we look at this, what we can see is, again, we have a range in price. We can see that price is caught between this high and this low. We're getting that price action, and then we get an expansion out of that zone. So what we can actually do is we can draw it from the lowest low to the highest high of that range, or more specifically, we could also just factor in this pivot in price as a pivot supply zone. So we had our range, just grab that. We have our range created supply. We have our pivot supply, or what we can do is we can actually refine it one step further and go to more of the candle that created the momentum on the overall pivot. So we have 3 different ways to map out this particular supply zone, all of which are valid, and ultimately depending on how big and wide you want your supply zone. So something like this was about 12 pips. If we move to the pivot in itself, it doesn't really make it that much smaller, which is about 11.5 pips. And then if we go to that last candle, this is where you'll get a much smaller, tighter, and more refined zone of 4 pips. There are times when using a refined zone are more advantageous from a risk to reward perspective, and there's times when you need a larger zone, especially if you're looking at something that's a little bit more higher time frame and you're waiting for price to return in to that zone, and then you're looking at lower time frame order flow to actually get involved. Again, we'll go through all of that, but just to get your mind thinking about some of these things. And like I said, there are many times where we're seeing that these supply and demand zones are just not holding, where we'll be able to build up frameworks of why these particular zones are not holding and what this is implying to the overall strength of the move or the inner workings of the order flow that we're seeing here on the chart. So now if we just keep moving on, what we can see is once we move to the downside, price forms another range, or specifically we get that sharp move before an expansion to the upside. And then if we just keep moving forward, again, we have a range or a sharp move and expansion to the upside. So we have 2 range created demands or 2 pivot created demands, depending on how you would like to view it. So if we created our range created demand here, we could draw it from the lowest low to the highest high of the range. We could simply factor in our pivot, which would be more so focused on these 2 bearish candles. We can see that sharp move to the downside before the expansion up. Or finally, the one last way we could refine this particular pivot is on the last bearish candle that creates the momentum that actually pushes that expansion to the upside. So a couple different ways of mapping that. And then again, we can move up to this next range created demand zone, which we can do from the highest high to the lowest low of the range. That would be our range created demand. We can see that we have that sharp move to the downside followed by an expansion to the upside. So what we can do is we can just map out the 2 bearish candles. Now, if we have an instance where there's a lower wick on the next candle, I like to also include that, because what ends up happening is if you only draw your zone to this point, and what you'll learn in entries is we start to put our stop losses based on the way the zones are positioned. And if we have our stop loss sitting here, the chances of getting stopped out end up being a little bit more increased, and we want to make sure that we're including the entire range of a particular zone, so we kind of have the highest amount of understanding of where price was delivering at that particular point within the premium and discount of the supply and demand zone itself. So in that case, just using the bottom wick ends up being a little bit more beneficial. And again, it only adds about 1.5 pips to the overall zone in question. So it's not something that's going to make or break a trade or make or break anything that we're doing, especially in this particular episode. So we keep moving forward. What we can see is we have a sharp move to the upside. We also have a range in price followed by another expansion to the downside. So we can suggest, so what this suggests is that we have a supply zone. We have range created supply, which we could factor in this wick, the highest high to the lowest low. This is a very large zone. This is a very large zone, about 15 pips. So what we can actually do is focus more on the pivot, which we would take these bullish candles. And again, this wick exceeds the bullish candle, so factoring it in is just a good practice to have. And then finally, what we can actually do is we can focus on the last bullish candle before that large move to the downside to refine our supply zone a little bit further. And we'll just keep walking through price a little bit further. And what we can see is we get a move to the downside. We get a sharp move to the upside followed by another sharp move to the downside. So what we can actually do is view this as a pivot supply zone, and we'll keep continuing on once again. And what we can see is we have a range. We also have a sharp move to the downside delineated by one candle. Again, this would be more of a refinement on our demand zone. Then we get that expansion to the upside, and we could draw it from the lowest low to the highest high of the range, which would be something similar to that, or we could draw something more like that, which would be based on the pivot candle in itself. And what we can see when we're just looking at these zones from a conceptual standpoint is that there are a lot of zones that simply don't really hold at all. You get a reaction, but no real follow through. You get a reaction, but no follow through. You get no reaction whatsoever. You get a reaction that's decent, you get a small reaction, no follow through, so on and so forth. And again, we'll touch on how to frame up higher probability supply and demand zones and understanding what this is ultimately suggesting from an order flow perspective, having supply being respected and demand breaking or vice versa. But conceptually, when we're trying to understand what is actually happening on a supply and demand basis, we'll focus on this zone right here, just because, as we can see, we get a move away. We have a range in price, which is suggesting that from a fair value perspective, a lot of orders were being changed hands at this point, and at some stage, selling created more of a movement, which is why we've seen that expansion away. And then as we can see, as price returned back to the range and back into the pivot, we had a reaction that caused a follow through. We came close, we had another follow through, and then we tapped into it a little bit deeper, and then we got another follow through, which continued to push a little bit further as we see. So what that means and what's that suggesting on a chart and why this is important to us is when we're looking at a range created supply zone, for instance, what's happening, as I said, is there are multiple orders changing hands in this particular range. There's fair value being met, and at some point the sellers overpower and price is moved heavily to the downside. And then at some stage price will move up and down, basically gravitating back to this supply zone, basically rebalancing the imbalance that was caused by this large move. But what this means is an institution or a series of large orders were placed to propel this move to the downside as rapidly as it was. But generally speaking, this would have been a smaller portion of a larger order. Institutions are generally speaking unable to position themselves fully in one go because their order sizes are just simply too big. This is basically why we see this large drop. And what they're hoping to do and what they're setting out to do is for price to return back to those price points so that they can then execute the remainder of their position and continue on their overall trend or trade direction that is being facilitated. Because again, we're having a bunch of volume being pumped into the market here. The full order is not there. This might be 25% of the actual volume that they're wanting to trade. This process right here is basically building liquidity and rebalancing the orders to push price back into this area because there is willing supply at this level. And then once price reaches this supply, this is where 75% or the remaining 75% is pumped into the market, which causes price to move to the downside yet again. And in a nutshell, this is what we're attempting to identify, and this is what we're attempting to create trades based off of. We are identifying the framework that institutions or large series of orders are being placed in the markets, and that's why we see ranges in price or sharp moves, pivots, that then create an expansion to the upside or the downside. The sharper the move, the more likelihood that a large order has been placed in the market. And that's why not all moves are said to be equal, in which we can see that this move is much bigger than this move here. And especially this is an actual full move of that zone, whereas this move is actually broken into two moves. And if we look at something like this, where this is a much larger move than, say, something like this, but at the same time, from a fractal perspective, and this is something we're going to speak a lot to, is the fractal nature of the markets, things that are happening on higher time frames and going down to the lower time frames. What happens on the lower time frames happens on the higher time frames. What happens on the higher time frames happens on the lower time frames. They're one and the same, but the picture has to be built from one time frame to the next. The argument to be made is whether things happen on the lower time frame first or the higher time frame first. They go hand in hand, but conceptually, when you think about it, things need to be built on the lower time frame because the lower time frames are what build the higher time frames. And if you can understand the fractal nature of what's going on within the order flow, you can begin to piece together the higher time frame picture. It takes a lot more volume and capital to move the market, especially when we're looking at higher time frame moves versus lower time frame moves. And this is, again, how we start to build trades. This is how we start to quantify certain supply and demand zones and begin to map them out accordingly. So again, we have our range created supply and demand and our pivot created supply and demand. We've been able to identify areas where we have range and pivot, and being able to refine from a full-on range or a full-on range here and move it down to a pivot, or be able to refine down to even simply one candle. We have a lot of different options in terms of how we're drawing zones, how we're refining zones, and we can keep running through this process as price goes on. And again, as you run through this example, and I highly recommend that you now hit the charts and you start to look at these demand zones and supply zones, both range created and pivot created supply and demand zones, map them out on your charts. Again, you'll probably have a lot of zones that are just intertwined within each other. You'll have a lot of zones that simply don't work. They don't get respected, anything like that. And by the end of the exercise, your chart's probably going to look incredibly messy. There's really no other way to put it. But what this exercise is going to do is it's going to get you thinking. It's going to get you comfortable with mapping out supply and demand zones. And what you'll begin to do is train your eyes to see supply and demand zones. And one thing that I recommend doing after you've completed this exercise of just simply mapping out supply and demand zones, again, don't worry about what happens to the supply and demand zones. Just worry about mapping them out and understanding the order flow and understanding what's actually happening from a candle to candle basis. Again, we're going to build on this so that we can start to eliminate certain supply and demand zones from what we're actually looking at, and also understand the fractal nature of price action and seeing a move like this, being able to capitalize on that short-term sell while also looking for buys on, say, a 1 minute chart, things like that. We're going to dig into all of these concepts, but the first and most important step is just getting comfortable drawing out the zones, drawing out the price action, drawing out the ranges, drawing out the pivots, understanding that interaction, looking at the different ways price moves out of these ranges. Do we get a full-on move? Do we get corrective moves where price is struggling to move up and down? Price is somewhat balanced. Do we get ranges being created? What is that suggesting? Are we in between two more outer supply and demand zones? And then what is this price action in the middle suggesting? Because if we look at this in the concept of supply and demand, we have our top range, our bottom range. We have an equilibrium point, and price is moving in a larger range. And again, we're on the 15-minute time frame. So if I were to move up, what we would see in this bit of price action is a range. And this explains what's going on in these smaller time frames, but now we're seeing the price action within it. And as we can see, when we look at the price action within it, we're looking at that equilibrium point, or the fair value between supply and demand. We can see that price is gravitating towards this. And this is exactly what's happening here. And this is explaining the fractal nature of what we're trying to convey here. But again, I'm getting a little bit ahead of myself. I want to build the foundation slowly, and I want to build it effectively. Now, what I want you to do after you finish this video is go straight to your charts and just open up a blank chart. It doesn't matter which currency, commodity, index, or whatever it is that you want to look at. Open up a chart, any time frame, and just start mapping out supply and demand zones. Now, of course, if you go to something like a lower time frame, like a 15-minute, a 5-minute, a 1-minute, you're going to have the opportunity of seeing a lot more supply and demand zones. There's going to be a lot more data and price action that you can study, but this is prevalent from the monthly all the way down to the 1-second chart, and you're going to see it. And really the process and the point of that exercise is to train your eyes to be able to see these very quickly and be able to, from that perspective, just map it out in your mind what's happening behind the scenes. Because again, we've been able to identify a apex demand zone and apex supply zone. We're seeing that price isn't really moving between it. And then we see that we have a larger range that's happening, say, on a 15-minute. So go to your charts, map out all of the supply and demand zones that you see using the references in the previous video. Have the infographic that I've created on another monitor or readily available that you can refer back to as you're navigating through the charts, so that you're comfortable with mapping out these supply and demand zones, so that you're able to see them, you're able to understand what's happening, you're able to draw them, you're comfortable in drawing them, and you just get better at identifying them quickly and efficiently, so that we can continue moving on and building on those pieces. Because it's incredibly important that you have a strong foundation of identifying these supply and demand zones, being able to draw them, being able to map them, being able to see them on a chart, being able to understand what's happening when ranges are created, seeing what's happening when you see pivots in the market, and being able to map them out efficiently and effectively so that you can make decisions. Again, we're going to build on this sort of knowledge. We're going to be able to understand what these supply and demand zones mean, what happens when a supply zone is broken or when a demand zone is broken, what the significance of a return back to a zone may imply. All of these building blocks we're going to build on, but at this point, the main and primary focus you should be having is just getting comfortable mapping out supply and demand zones.